Hello, everyone. This is Jared Faltys. I'm a CPA and partner with McMill CPAs and Advisors. And here really to just give it a brief market update and talk about what the media is talking about right now with inflation. There's going to be some data coming out tomorrow and Thursday, and it's going to put into perspective inflation and where we're at as an economy. So I'll go over the market update for the second quarter of 2021. I know a lot of you already got your statements and had pleasant surprises with the market overall. So on the upper left-hand corner, the U.S. stock market overall for the one quarter went up about 8%. You can see the average quarterly return right here at 2.4. And so as Warren Buffett talks about, the stock market in general should do around 8% a year on average. Some years you're going to have a lot of ups, some years a lot of downs, but on average it'll be about around that 8%. So to have 8% for the one quarter is an extremely good quarter, way above the average. You can see international stocks not quite as good as the U.S. The international's kind of been down the last few years, but that's right at 5.65%. Global real estate right at 10%, and then bonds at 1.83. You can see the average 1.2. I think bonds are really interesting. With historically low interest rates, why are bonds generating 1.83% when just for the quarter, when interest rates are so low, almost virtually flat? And really, there's been a flight to safety, is kind of the way we describe it, to where people are flocking towards that safer investment, and that's really where the bonds come into play. So that there was definitely demand for the bonds, and that's what created that increase of 1.83%. A little bit about the noise. So we got the quarter, and we just kind of highlighted a few of the news items that we felt were worthy of talking about. The one way on the left, the U.S. added 916,000. I know there is a report out this week, added a very similar number. And so the economy is really starting to surge as far as getting restarted and adding those jobs. So everybody's watching that. There's negative news about inflation, and that's what we'll talk about today. And then the stock market continues to hit a new high. And there's nothing wrong with that. Every year, throughout time, it hits new highs on average. So we'll go through a little bit about the U.S. stocks. You can see for the quarter, large growth companies were the ones that did real well. Now, with our investments, we invest in large growth, we invest in a large value, small growth. What large growth tends to be is a lot of tech companies, Amazon, Google, those would be kind of those large growth, and large growth did extremely well, had record earnings. Large value, Nucor is a favorite here in town. That's considered a large value stock, and Nucor's definitely had a great year. Smaller companies we lean towards, and small companies are definitely doing its thing, what they're supposed to be doing. And why we lean towards smaller companies is really to lean towards companies that is almost like, when Amazon's already in Amazon, it's already had its growth. If you can buy a slug of companies that aren't Amazon's yet, that's academically where the bang for the buck is. You can see what the 10-year return is. I think it's kind of interesting, like Warren Buffett says, around 8%. Well, large growth did 17% for the last 10 years. And that's just a little bit out of the norm. Sometime it's going to have to get back to reality a little bit, but that's where large growth is. You can see small cap and small value. It's doing what it's supposed to be doing, around that 10 to 11% over time, and it's exactly where it is. So talking about, really just focusing on what we need to focus on. And when you look at the middle of the magnifying glass, create a plan that fits your needs. Definitely work with us if you feel that it's time to revisit your allocation, time to relook at a plan, maybe revise the plan. I think now is a great time to do that. We get you diversified broadly. We're reducing expenses and constantly focus on rebalancing, selling high and buying low. But like I said, the biggest talk is inflation. What is the noise? And really, our goal, not only myself but yourself as well, is to ignore what's outside that magnifying glass. That's what the media constantly beats on us every day, and inflation is going to be the one hitting the headlines. So a little bit about inflation. Overall inflation really is normal. We should expect inflation. And I thought these two pictures kind of depict what inflation is. So throughout time, our dollars become less purchasing power. It's tough to buy the same things that we bought a year ago and so forth. So that's really what inflation should mean to us. Now, why I say that we should expect inflation, overall the economy, we like inflation. When you think about that, a good healthy number is 2 to 3%. If sales go up 2 to 3%, profits go up 2 to 3%, and then stock prices go up because it's based on the profit of the companies. And so inflation is a healthy thing. When inflation rises quicker than maybe what we expect, then that's where the market kind of takes a step back and says, okay, what is going on? Are wages going to be going up and eating into those profits? And that's something to watch. So really, we just kind of picked easy pictures. A bottle of ketchup back in 1947, 24 cents a bottle. 2021, $2.99. And really, that's just showing that that $1, would have bought you roughly 4 bottles back in 1947, and now you can't even buy 1 bottle of ketchup today. So that's the loss of purchase power that I'm talking about. So why the economy and why the media is talking about inflation? So of course we got to throw a chart out at you, and what this is showing is the last 12 months is what this top circle is. Way on the right, 12-month CPI. What a CPI is Consumer Price Index. That's the government's way of measuring what is inflation by measuring the rising price of goods that a consumer uses. So over the last 12 months, when they look back, is right at 5% is what that line is. And so the CPI measured that goods rose by 5% over the last 12 months. When you go back the last 24 months and you factor in, the period of shutdown with, the pandemic, we're averaging right at 2.5%, which is what is considered normal is. So this 5%, although is, unexpected, really we should have all expected it. Just with shutting down the economy and restarting the economy, there's going to be demand out there because we all put on hold for demand of our goods, and then all of a sudden we wanted goods all of a sudden, and the factories and all that weren't ready for us. So it just takes a little time to kind of get back to normal. I think the biggest thing that we've seen is lumber prices and cars. That's the biggest topic in the media right now. And we've seen lumber prices spike to just abnormal numbers. And since then, the demand has kind of met with supply, and lumber prices have come down. And same thing's happening with cars. They finally got the computer chips, in circulation, things like that. Cars are going to be coming out, and supply and demand are going to be meeting. So that should help curb this inflation talk. So going back to 1970s was definitely the period of high inflation. Whenever you talk about inflation, everybody has to go back to the 1970s. And really what was happening in the 1970s, the biggest talk was the oil embargo, and just the lines in the pictures. This is New York City, showing people waiting for a gallon of gas. Back then, the Fed Reserve, I love this picture, smoking in front of Congress, talking about raising rates to 20% to help curb inflation and take care of the demand that people had. And President Carter was signing legislation to help with the oil embargo and just kind of curbing that demand of the natural needs that we had. With the 1970s, could it get any worse? I Googled the top song in the decade, and it's You the Light of My Life by Debbie Boom. And if it can get any worse, I took a picture of John Travolta doing some disco. So that's really the 1970s, the period of high inflation, but we made it through. Stock prices continued to rise even after the period of high inflation. So really the truth about inflation, who really pays for it? And I really like this picture of just people sitting at a local cafe, having breakfast, having the newspaper open. And you can see in the upper right-hand corner, prices are going up. And they can talk about whatever subject is in the media, whether it's, the tax plan, whether it's infrastructure, at any time there's news about what Congress is going to do or not do. But really the business and capitalism adjusts. And really this picture on the right just shows that no matter what happens with the economy, businesses are going to adjust. They're nimble. They're not going to just sit there. And really when we look at your portfolios, we invest in companies. We invest in stocks. We believe in capitalism. And that's a good thing, even with periods of inflation. So when you see news about inflation, which you will see this week for sure, just remember that, if not the majority of your portfolio, real close, has and believes in capitalism. And when you think about these store owners, such as the CEO of Walmart, when prices rise, the price of toothpaste or whatever it takes to put on the shelf, that product rises by 9 cents. Walmart's just not going to eat it. They're going to increase the price on the shelf so that the consumer absorbs that. So Walmart always protects their bottom line, and that's Walmart's goal. That's why they do what they do. And not just Walmart, but 10,000 other great companies worldwide. So that's why we just have to believe that we need stocks no matter what age group we're in. Stocks will always hedge against inflation. That's our best bet against inflation. So really this is going back to 1947. So on the left shows really $1. Oops, sorry about this. On the left shows $1 being invested back in 1947 and what happens with that $1. So you can see this top line is small companies, just handpicked, the U.S. small, which is what we lean towards. And that $1 grew to $232. You can see treasury bills or bonds. That $1 is pretty well kind of just maintains that $1 status. And you can see just if you buried your cash in a cream can in the backyard, that $1 loses purchasing power over time. That $1 becomes 8 cents. So loses about 92% of its value over time. And so really this just puts in perspective that we have to have stocks in our life. With the pandemic and the shutdown of the economy, one of the biggest world events probably in the history of the market. And this has taken $1 and looking at the Russell 3000, the 3,000 companies in the United States, and what did happen in that period. And so if you go back to January of 2020, you can see that $1 slowly rising, and then all of a sudden we had the sharpest drop ever on record. Not the biggest drop, but definitely the sharpest drop, where that $1 went down to below 70 cents. Really, most of our clients, if not all of our clients, maintained with the help of us. We helped them, they helped us, but we maintained our diversification. And not only did we maintain it, but we bought stocks when they became cheaper. This is a lifetime of an opportunity to, or opportunity of a lifetime to buy stocks when they became cheaper. And so by buying stocks as this sharpest drop happened, we're buying it cheaper and cheaper, and then the stocks rose quickly and kept continuing to rise throughout the year. So sticker shock, what does the market think? And really this is a VIX index, and all that means is collectively the market's measuring really the emotion in the market, what they perceive as volatility in the market. And really this is just data showing that, the height, which is really no surprise, the height of volatility that the market perceived was March of 2020. And March 23rd of 2020 was the bottom of the market. So that's when the Dow was going up and down 1,000 points every day. And since then it has settled down. So I think this chart is showing two things. One is, when world events happen, people become emotional. And when people become emotional, I'll show you a next slide that sometimes uh, emotional feelings don't make the best decisions. But this slide also shows that everything's kind of getting back to its norm of what we expect for volatility with the market. So this is a slide I kind of wanted to dovetail with the prior slide, is that in the month of March, and this is going from January of 2020 to March of 2020. In the month of March, we saw that decrease, and like I said, the bottom of the market is March 23rd. When that market was going down and everybody was volatile, everybody was emotional, like the prior slide I was showing. What this blue line is money market flows. What it's telling us is that collectively, overall, as the market was going down, people were taking their money out of the market and putting it into the money market. And that's exactly opposite of what you're supposed to be doing. When that market was going down, really this line should have been following the market and buying the market when it was cheap. That's exactly what we did for you, is that we took that money and we sold the areas that were considered high, we rebalanced and bought the areas that were low. And those trades were tremendous for return. So unfortunately, the rest of the world, when you think about us wanting to buy at a bad time, people needed to sell at a bad time. Unfortunately, those are the ones that lost because they sold at a bad time, and those are the people that put their money in the money market. What I think is further interesting is that as the stocks grew, and you can see the returns of 11%, 4.6 for these monthly returns, then people start to say, hey, I want to go back in the market. And by then it's somewhat too late, that the market's already had its run. So this is really what we've been doing all along, is just really focusing on rebalancing and selling when it's high and buying when it's low. This is not what we've been doing, actually. When the market was going up, people tend to get greedy and want to buy and get fearful when they want to sell. That fearful was March 23rd, when people were bailing and allowing us to buy. This is what we're focused on, is constantly selling, rebalancing, and keep doing that for the portfolios. So really conclusions, even with the inflation worries, really stocks are where we need to be. It's a hedge against inflation, and we have to believe in capitalism. So even though you hear the media saying we've hit all-time record highs in certain areas, there's certain areas that have not hit all-time record highs. And now's a time where diversification really makes sense. We need to focus on diversification in good times and bad. And so, yeah, John Travolta, the debate continues about him. But I think the biggest thing is, I think as the media is going to talk about inflation or any other topic, we just need to maintain that long-term approach. So that was really just a quick overview of what we saw in the market, kind of a quick overview of what happened last quarter. And, when you see the inflation news, go ahead and ignore it. Read it for entertainment. It's good to read and know what's happening with the economy, but don't let it affect your long-term approach to your investments. Thank you.